Well, hello everyone. Phil Kewen here. Great to have you here again. Welcome to the latest in our series of COVID-19 webinars, where we're doing our best to keep you up to date with the latest news and activities. And there is a lot of news and activity going on in the industry at the moment, but now is not the time to talk about anything related to the AFA and policy, etc. It's more about investment markets, and we know that you're having a lot of conversations with your clients about investment markets, and things are changing daily. And the COVID-19 pandemic has continued to, shape how investment markets are responding. And so it's important to know when you're talking to your clients, what is happening in investment markets, how that's impacting your strategies, whether you should be changing strategies or staying the course. So you need to keep informed, as we do, and keep your clients informed. And so we have someone well credentialed to keep you informed today. That's why we've partnered with Morningstar to bring you today's webinar, and presented by Clint Abraham. And Clint is the Director and Portfolio Specialist at Morningstar. So Clint will bring you the latest market intel on how the pandemic is driving markets and investment strategy tips to help you support your conversations with your clients. So importantly, Clint has 16 years of experience, so he's seen many ups and downs, and we were just having a good chat about it before we came live here. He's been involved in financial markets, as I say, for more than 16 years, having worked for Goldman Sachs, JB Ware, Morgan Stanley, Smith Barney, and a specialist financial intermediary broker, Longtech. Prior to joining Morningstar, Clint is head of trading and portfolio management at Wentworth Securities. He managed the firm's multi-asset portfolios. He has considerable experience in formulating and implementing investment strategies across multiple asset classes. Importantly, Clint sits on the investment committees determining the investment strategy at Morningstar. So really looking forward to hearing from Clint today. But before I hand over, just a few housekeeping issues, if I may. So today's webinar has one CPD hour available. So if you watch this webinar in full, you will automatically be sent a certificate with your CPD. If you choose not to, there will be a recording afterwards that you can watch that will be loaded onto the AFA website, but you will be required to do a quiz if you choose not to stay live. But you will be muted along the way, so don't worry about talking. We won't be able to hear what you say. Clint will answer questions at the end of the presentation. He'll run through the presentation, then he'll answer questions and answers. Can I just ask you to use the Q&A function at the bottom of your panel, not the chat function? So that's the Q&A function at the bottom of your panel, and we'll endeavour to answer as many of your questions as possible. I'm sure you'll get lots of useful information. We want to continue to bring you these webinars, so we welcome your feedback. So please feel free to do so at info@afa.asn.au. So on that note, it is my pleasure to hand over to Clint Abraham. Clint, thanks so much for joining us today.
Thank you, Phil. Thanks for having me along. Good morning, everyone. Thanks for taking time out of your day to join us. If I could extend Phil's comment there around questions, I really want this to be an opportunity for you guys to ask questions that are on your mind, or certainly that your clients may be concerned about in this time. There's certainly no shortage of volatility, and news flow seems to be changing almost by the hour. So I'll do my best to share how Morningstar think about these types of events, and hopefully distill a little bit of the noise that's out there at the moment. And it may help, hopefully, to frame the conversations that you're having with your clients at this uncertain time. So for those of you that are relatively new to Morningstar, I'm very much a global asset allocation business. So it has its roots in the Ibbotson business, which some of you may recall from your financial textbooks. That Ibbotson name is across all of the foundational work around asset allocation. So understanding how we value asset classes like shares and bonds, and how we blend them into a portfolio that helps deliver an outcome for our investors. As you can see, they're very much a global business with hubs in London, Sydney, and Chicago. Before we move into some of the more detailed analysis of what's going on in the world, Warren Buffett, who many of you would know as certainly one of the best known, most highly regarded investors that we've ever seen, he has a very useful framework here, which I just wanted to share with you because it's very helpful in trying to understand how many of the events that we see in the world, not just right at the moment, but generally speaking, there's always something going on, how we might approach some of these events. And the framework, as you can see there on the left-hand side, has knowable and unknowable across the top, and important and unimportant down the left-hand side. And I want to suggest to you that most people don't want to spend their time concentrating on the unimportant stuff, but I want to further suggest that many people spend their time in the top right-hand corner. And so what I mean by that, if we think back to 2019, some of the events that would have been front of mind for investors, we would have been talking about things like trade wars, Brexit, the outlook for interest rates, what central banks are up to and so forth, potentially geopolitical issues from time to time. I want to suggest to you that many of those sit in that top right-hand corner, in that they are hugely important, but they are generally very, very difficult to predict with any accuracy. And even if you were able to form a view around some of these things, that doesn't in itself lead to an investment decision. So the way that we try and approach these things is from the top left-hand quadrant, which is what is important and what we do know and what we can measure. And for us, that's an understanding of the value that's in a particular asset. And more specifically, what we're looking for there is we can analyze and we can make an assessment of the quality and robustness of cash flows that an asset might deliver, and that could be things like dividends, and we can understand what a fair and reasonable price to pay is for those assets. And that proves a very useful framework for moving through time when all of these other things pop up and ultimately slide into the background over time. So the reason that we approach it this way is that there's a lot of research out there that shows you, for everything that's going on in the world, the best predictor of your future returns from an asset is the price that you paid in the first instance. If you got a good deal, if you were able to pick up something cheap, then you can expect that to reward you for years to come. But if you paid too much, if things were expensive, then that presents obviously the risk of loss. And the reason I mention all of this up front is because I think you'll find that that resonates very well with clients too. They too like to get a bargain in their everyday lives in the same way that we do. We're just trying to do it with financial assets. One of the things that comes out of being a global investment manager is this set of 7 investment principles. And I'll just spend a couple of moments here because it will help provide context to what comes later in the presentation around what we're looking for in assets and how we apply this framework to the current investment environment. I just wanted to call out the second one here, being independent-minded. So again, if I quote Warren Buffett, he has a fantastic range of quotes, and many of them are applicable to how we think about investing. He has a saying which I paraphrase as being greedy when others are fearful, and fearful when they're greedy. And there's quite a lot in that statement, and it really goes to the heart of what behavioral finance talks about, which is understanding how emotions can influence an investor's behavior. And in fact, that's something that's very key to Morningstar's process. We know that in times of euphoria, when it feels like markets are going to go up forever, when times are good, people feel like they're going to miss out, and they tend to buy into a market at any price. And arguably that was happening throughout much of 2019. Fast forward to now, where it's much more uncertain. We've got a potentially significant economic risk and health risk in the near term, in the near horizon, and people are understandably feeling very uncomfortable. Our contrarian nature means that we are more likely buying when other people are selling, because they're more likely to make an irrational investment decision to sell at any price to remove those feelings of anxiety. Key in that is the third one there, investing for the long term. And so if you think about the psyche of investors at the moment, very much short-term focused, almost lurching with every new piece of news flow and trying to position accordingly. And we've seen some enormous swings in share markets in particular, which again is very consistent with this initial phase of panic and uncertainty that plagues investors from time to time. When you have a long-term outlook, it's a very calming and stabilizing force from which you can use to navigate short-term uncertainty. And indeed, if I take that one step further, you can use short-term panic and mispricing to position for longer-term gains. If, again, you're able to analyze the robustness of the underlying cash flows. Again, the valuation piece I've touched on briefly there. We want to understand if we're getting a good deal or not. And then to take that one step further, we want to buy good quality assets, and we don't want to pay full price for them. Again, I think that analogy will lend itself very well to clients who are always looking for something good quality on sale. Okay, so let's jump into it a little bit. We've seen a significant change in our conviction toward a number of assets over the last quarter. And again, this is very much this contrarian nature, moving to buy when others are selling in the face of adversity. And if I just draw out a couple of these here, we're showing the key share regions in the world in the first half of this slide, and the December 2019 conviction on the right-hand side, and then the mid-April conviction, one column in from the right. And what you can see there is on the right-hand side, there wasn't very much in green. We actually found the end of 2019 to be among the most unattractive opportunity set that we've seen for some time. So what does that mean? It means that, and you guys will be familiar in this industry, quite often we talk about return, but we don't always talk about risk. Morningstar are very much of the view that when you talk about return, you need to have that conversation about risk in the same sentence. And so as at the end of 2019, we felt that the opportunity for future returns was actually quite low, and the risk of losing money that could never be made back was actually quite elevated. Not that we knew the catalyst or the timing, and obviously COVID-19 has proven a very significant catalyst in that regard. But if I could say it as if markets were somewhat vulnerable to a sell-off, whatever the catalyst and the timing may be. And that's simply because investors were pricing in too bullish, too good an expectation around future corporate profitability and economic growth. Said another way, they were pricing in very little room for error should something come along that would disrupt corporate profitability or economic growth, and therein raises the risk of loss should an asset move back to what it's fundamentally worth based off its cash flows. And so what that tells you there is that would lead to having quite defensive positioning in that environment. That would lead you to hold much more cash than you otherwise might, because the risk of losing money is much more elevated. You can see, again, if you come in a column to the mid-April conviction there, now it is a much better opportunity set. And in fact, this is the best opportunity set or range of opportunities that we have seen in at least the last 5 years. And part of that is, well, all of that is predominantly because we have seen such a significant pullback in share markets, which I'll touch on a little bit later. We are now being much more fairly compensated. It no longer warrants holding the same level of cash because you are getting rewarded to look at some of those more traditional share market asset classes. Now, of course, we can go a little bit deeper, and in fact, Morningstar value and measure 350 asset classes around the world every month. And so I'm showing you a very small and high level selection of what that looks like. But if nothing else, the key takeaway from a share market point of view is that our expected returns are, generally speaking, close to fair. We're getting a reasonable return. Some markets like the UK we would consider cheap, and I'll touch on why that's the case a little bit later. Others like the US, not as cheap, and they rank behind the other regions, as you can see on that chart. But generally speaking, for shares, we're being much better rewarded now than what we were at the start of 2019. And more broadly, this is, as I said, the best value that we've seen probably for about 5 years, I would say. Certainly, early 2016 springs to mind as being the only other time where we're sort of seeing the level of expected returns around where we can currently see them. Of course, the market's rallied a little bit over the last few weeks, and so that would diminish that slightly. But nonetheless, the green arrows that you can see down the right-hand side of the chart there, they recognise an improvement in conviction towards those particular asset classes. The one exception that you can see there is for US government bonds. And so what happens in an environment of uncertainty is that people gravitate towards government bonds as a flight to safety, if I could say it that way. And so what we saw is US government bond yields fall to record lows. So the 10-year bond yield down below 0.5%. Our own Australian 10-year bond yield fell significantly as well, marginally higher than the US. But in each case, and in the case of bonds, generally government bonds, those yields are very, very low. So we think that the risk of loss in bonds is actually still reasonably significant. And if I take that one step further, when you think about how we're using bonds in portfolios, which is to be a source of income and to help offset share market risk, we're not sure that bonds can have the same ability to do that at the moment, simply because the starting point for those assets is quite expensive. And so what we saw when we had the volatility really playing out in March, there was a period of time there where both shares and bonds were falling. And so the traditional diversification benefits didn't really hold up. And to be fair, there was also some liquidity concerns around that time as well, which was influencing that result. But nonetheless, this is where cash really holds its own in that type of environment. To give a little bit more detail around how we think about some of our investment themes, what you'll see is they effectively go through a life cycle over time. And so on the left-hand side, some of these areas that are now increasingly interesting to us as a result of the most recent period of volatility that we've seen. What you've seen generally is that those sectors, those companies that are exposed to the economic outlook, so we would say in the industry that they are cyclical as opposed to being defensive, they have been really badly beaten up, and it's just simply concerns around the outlook for global growth that are feeding into poor sentiment towards those sectors. So that's things like energy companies and financials, so banks. I'll touch on all of those a little bit later. And obviously with COVID-19, really affecting travel and airlines in particular, so the broader travel sector, so hotels, cruise liners, etc. Very acute underperformance there. And in many cases, people questioning the viability of those companies, given that sector's been pretty much put into lockdown. A-REITs, if you think about shopping malls, there's no longer the same level of foot traffic that's going through those, although that appears to be about to resume in some capacity. So then there's question marks again around the viability of some of those tenants. In terms of office space, obviously we're all working from home these days, and so there's question marks in that space too around how much the demand for office and commercial property will change as a result of much of the economy and the workforce being put into lockdown. And then some specific parts of the debt market, which I'll touch on in a little bit later. As you can see, there's some others that are beginning to mature. Cash is the most interesting one there, I think, from our point of view. Having held quite a bit of it for a while, we're now seeing much better opportunity to deploy that into ways that we think will add value for clients. And then on the right-hand side, some of these investment themes that are now moving on, they're mature and they're starting to leave the portfolio. I touched on government bonds just a moment ago, and certainly more defensive sectors like consumer staples, which covers many of the companies that make the products that go into your shopping trolley every week, and healthcare, given that they've both held up relatively well. The appeal of some of those sectors is now much more diminished. Okay, so let's dig into a little bit more detail what's been happening in the world. And there's really been two key drivers of the volatility that we've seen over the course of 2020. The first is fairly obvious in terms of coronavirus. So COVID-19, as of last night, there's now 4.2 million cases of infection worldwide. Roughly 1/3 of those are in the US. Again, as at overnight, almost 300,000 people have sadly passed away as a result of infection from the virus. And while we have seen some countries like Italy and Spain, probably most notably, beginning to slow the curve, other countries, and the one I'm thinking of here now is Russia, appear to be a bit of a hot spot. Russia is now the country with the second highest level of infection behind the US. And I think what's really important with coronavirus is that it's extremely difficult to predict how this is going to play out. We certainly didn't predict it in the first instance, but even from here, we do not know if we're going to be able to fully get back to our lives anytime soon, even though there's definitely what appears to be some measures starting to be relaxed that allow us to go back to our normal lives. But we don't know if we're going to get a second wave of infection like we did with the Spanish flu. We don't know if a vaccine is going to be made available anytime soon. And it's very difficult to understand what the ultimate health cost will be. Now, as you know, we must also try and figure out what the economic implications of this are. And I think that's equally difficult, notwithstanding that there's a general consensus that the economic implications are going to be quite significant, both in terms of economic growth and corporate profitability. But again, we simply don't know how deep and how long lasting the effects of coronavirus will be. So some of you may have heard this term in the media, which is a black swan. A black swan simply refers to an event that is very hard to predict, is very rare, but when it comes along, it can have profound implications for financial markets and certainly society as a whole. And I think you'll agree, coronavirus absolutely represents that. Obviously, it's also been declared a global pandemic. And when you have a look at the effects of coronavirus on markets, it has been very widespread. Most share markets have fallen. Yes, at the margin, there'll be some difference between sectors and countries and things like that. But generally, share market performance has reflected the global nature of what coronavirus represents. The other thing that you may be less aware of is in terms of discord in the oil market. Now, back around the start of March, the OPEC cartel, which is a consortium of oil-producing countries that meet regularly to discuss supply and pricing and so forth, they had one of those meetings, and the proposal in that meeting was to continue with production cuts out until the end of 2020, so limiting the supply of oil coming into the market. Now, Russia, while not formally a member of the OPEC group, they've certainly been towing the line of the alliance up until quite recently, when they refused to go along with this proposal to maintain production cuts. In response to that, Saudi Arabia effectively jawboned them into line by increasing the supply of oil into the market and by selling oil at a discounted price to key partners. And this proved ultimately successful. Russia has since fallen back into line, and we have seen some production cuts maintained out until, as I said, December 2020. So why this is really important is because you have a situation, or you had a situation, where potentially an increase in oil was coming into the market, just as, and oil is widely referred to as the barometer for global growth. So coronavirus is expected to have significant implications for global growth and the economy. There's not as much oil required any longer. And this is happening at a time where there's potentially more supply hitting the market. So those two don't sit well together. And what you saw is a significant fall in the oil price. Depending on where you were looking at it in March, you saw falls of between 40 and 60% calendar year to date at that time, which is a significant correction. Not unprecedented, mind you. We've had periods where oil prices have fallen heavily in the past. Often that coincides with when members of the OPEC alliance are at loggerheads, but certainly that was a very, very sharp correction, and again was key to influencing sentiment towards the broader share market. So those two things alone, while we've got a little bit more clarity around the supply side of oil, the demand side now is still very much in question given the implications of coronavirus. And as I said, both of those are extremely difficult to predict how they're going to play out from here. But the other thing that we must take into consideration is how governments are going to respond to that. And it's not just governments, we're talking also around central banks. So our own Reserve Bank here in Australia, US Federal Reserve, Japanese Central Bank, European Central Bank, and so forth. And if I'm a central bank, my primary tool to help stimulate the economy is through cutting interest rates. But the problem is, for much of the developed world and now Australia, that lever has been pretty much pulled. We have interest rates that are very close to zero now. And so the question for central banks is whether they take interest rates negative, like they have in parts of Europe and Japan, or whether they embark on some sort of a quantitative easing program, or both. And we actually have a bit of a playbook for this one too, because the Reserve Bank governor has come out and said, well before coronavirus, when he was outlining his plan to stimulate the economy as required, that he does not favour going down the path of negative interest rates, but would much prefer to engage in some sort of a quantitative easing program, whereby they would be buying Australian government bonds. And that's actually what's taken place as a result of the volatility that we've seen in markets, and obviously the effect on the economy as people lose their job and so forth as a result of lockdown. The RBA has come out and they have begun buying Australian government bonds in an effort to send a signal that we are in a lower interest rate environment for the foreseeable future. And that will hopefully give if I'm a small business and I'm looking at investing in plant or machinery or human capital, that hopefully gives some confidence that we're going to have that lower interest rate environment for quite a while yet. And governments, as you've seen, our own government has delivered very significant stimulus to those that have lost their jobs in the hope that they can soften the economic blow of what COVID-19 might present. And that's been very much reflected right around the world. The numbers of the US stimulus package in particular are simply mind-blowing. So we kind of have three things here, which mean coronavirus, oil, and the government response. All three of those in their own right are very challenging to make a forecast around, and certainly to position portfolios off the back of, let alone when you've got all three of them happening at the same time. And so again, this is, if I cast your mind back to the first slide I shared with you about understanding what's important and what is knowable, these things are definitely important, but they are generally unknowable. In terms of the impact on markets, what we saw is share markets rallied for the first 6 weeks of 2020. That's very much a continuation of the theme that we saw throughout 2019, where it felt very good to invest. But from February 21, share markets went into a significant sell-off. And that was typically in the order of 30 to 35%. And it happened very, very quickly. In fact, in the US, it's the fastest bear market that we've ever seen. So a bear market, again, you might have heard this term in the media, and it really serves no other purpose than allowing media types to report. It's a fall of 20% or more from peak to trough. And as I just mentioned there, share markets fell, in fact, quite a bit more than that. And very, very quickly. So it's understandable if you've got clients who are actually, the last time they checked, maybe Christmas or in the new year, it felt like everything was okay. And then you see significant share market falls, which impact their nest egg, of course. That fall coincided with confirmation that the COVID-19 virus had spread more broadly. Obviously, key countries in Europe were becoming infected. Lockdowns were starting to take place. The WHO declared it as a global pandemic and so forth. Following that period of loss, again around 30 or 35%, we've actually enjoyed a pretty strong rebound. So that occurred from around March 23, really till about now. And that rebound, as I said, was quite significant. And so if you have a look at share market returns year to date, so really capturing 4 months or so, what you see is that shares are actually not down that much. They're only down a little bit over 10% in local currency terms, so not taking into effect the effect of currency, which is perhaps really quite surprising, and it certainly belies the level of volatility that share markets have gone through to get to this point. What gave investors renewed confidence at that time? Well, there's a couple of things. Firstly, investors are taking much more confidence that the government and central bank measures that are being put in place may well be enough to see us through this period. So they're responding to the stimulus packages that have been put forward. And more recently, they're certainly taking additional heart from what appears to be a slowing rate of infection in many of those key countries that have been infected up until now. And again, that's giving much more confidence that we're perhaps through the worst of it. And as you would have seen more recently, we're starting to see a relaxation in some of the social distancing requirements that have been put in place to try and stem the spread of the virus. Whether this proves premature, we simply don't know. We don't know if we're going to see a second wave of infection. We don't know what the economic and certainly corporate profitability implications are going to be. But I think it's pretty safe to say the near-term implications, company reporting numbers and so forth, they're going to look pretty awful for a while. But again, as long-term investors, we must ask ourselves, what is a temporary impairment of profitability and cash flows versus something that is more permanent and sustained? So what does this mean in terms of our investment process and where we can see opportunities? And as I touched on here, we're seeing much better returns among broad equities, certain pockets of the corporate debt market. So what that means is obviously companies will go to investors and issue bonds as part of an attempt to fund their ongoing activities. And the investors in those markets are very mindful that corporate profitability is going to look not good for a little while. And so they're going to demand a greater interest rate to lend to those types of companies. And that's particularly the case for high yield debt there on the left-hand side. You may know that as the junk bond space. So very much up and coming junior companies don't have the same robustness and maturity of cash flows as some of their more investment grade peers. And they can be particularly vulnerable if the outlook for global growth diminishes significantly. And there's a key component in there around energy companies that would use that funding to effectively explore for oil and gas reserves and other things like that. So people, if they're lending into that space, they are demanding significantly more compensation to do that. Our argument would be that we understand that thematic, but at the moment they're pricing in an unreasonable level of default in that space. And so that's potentially a small opportunity to invest for portfolios there. What can we see that looks quite negative? And I think these are probably fairly intuitive, and you might even be starting to see some of this come through in terms of corporate reporting. And I cast your mind back to a week or so ago, we've had 3 of the big 4 reporting, and many of these you can start to tick off. So profitability looks awful, and certainly the numbers look very messy. We're seeing dividends being cut or deferred, share buybacks being cancelled. And then, more broadly, when we look at some of those yield type investments, yields on cash and bonds are very low. And we saw liquidity risks in the bond space throughout that period of volatility. So I touched on that point before, where both shares and bonds were falling at the same time. There are very few buyers around for bonds in that market, in Australian bonds notably there. So people that were wanting to sell out, there wasn't always sufficient volume for them to sell. And then, of course, downgrades and defaults, which we're probably in the very early stages of. We can certainly expect some more of those. Again, Virgin springs to mind there in terms of its own viability throughout this period. So when we have a look back at how this compares with points in the past, and many of you would have seen a version of this chart in the past, we're simply looking at returns by calendar year across a range of asset classes. And the obvious thing that jumps out to me here is that the only other column of significant red that I can see like this is taking us back to the global financial crisis. Generally speaking, we're not anywhere near there, but it certainly has been the most significant falls that we've seen since that period. And as I touched on before, they actually happen very, very quickly. What's also surprising, and I'll just bring you on to a slide in a couple of time. I will pick up that point in a moment. When we look at the US in particular, again, our question around understanding how much of this is temporary versus how much is permanent, what you can see there is, potentially this is undoing 10 years or 12 years of employment growth. And again, much of this is still to be decided as it's determined how we are able to resume working, and whether these job losses are a precursor to jobs being recreated and people going back into the workforce, or whether this is something more structural that takes much longer to overcome. So there's been a significant shift in investor focus over the last little while, and I touched on this at the start. If we were doing this call this time last year, we would have been very much talking about the things of the day, which would have been the outlook for trade wars, Trump in his efforts to make America great again, and Brexit. While the UK is now formally left, there's still quite a bit to work out what that ultimately looks like, and presumably that will be delayed to a point now because of the COVID-19 implications for the UK. But what we can see now, we're very much focused on the outlook for what coronavirus might be, as difficult as that is to understand in both a health context and an economic implications context. So this has been quoted in the media, and I agree with this. We have a situation where we have an unfolding health crisis, and it's now rolling into what is potentially an economic crisis. What that means in terms of underlying profitability and default and all of those things captured in that red dot there, we're yet to find out. But it has been a very sharp shift in focus, and many of those things from 2019 have simply gone onto the back burner. I think it's also worth highlighting a lot of the language at the moment is drawing out that coronavirus is unprecedented. And it certainly is, to the extent, I mean, we've never had a virus like this before. Some can make comparisons back to the Spanish flu, which falls outside of most of our lifetimes. But I want to just suggest something to you here in terms of how it may help to frame what coronavirus is. And I want to suggest that many of the events that we've had in the past that have led to market sell-offs have themselves been unprecedented. So if you think back to the GFC, the tech boom and bust, the Asian crisis in the late 90s, we can go all the way back and look at the Great Depression and so forth. Many of the periods of volatility and significant loss that we've experienced in the past have themselves been unprecedented. So just keep that in mind when you hear this word at the moment. My 13-year-old son, who's very good with technology, brought up Google Trends, and it had on, he actually searched the word unprecedented, and it's a proper exponential curve given its use in media at the moment. And while that is true, I just want to say many of the events of the past have themselves had these types of situations which have never been encountered before. But over time, share markets continue to move higher. And in fact, they are going to be the key source of driving returns for your clients' nest egg. So it's helpful to take that broader context. While we haven't specifically dealt with a virus of this magnitude on markets, what we have done is we have experienced periods of volatility in the past, and we know almost certainly how humans are going to react to it. And that's happening again this time. And that is simply that they don't like that uncertainty. I touched on the behavioral angle a little bit before. They're much more likely to sell in panic, and in doing so, they sell at any price just to remove those feelings of anxiety because it feels uncomfortable to hold that investment. And so we've seen examples of that, again, particularly at the start of the sell-off that was very aggressive. And as I touched on, we were seeing very significant moves in share markets at that time. We would expect, humanity will get through this, I'm sure. And over time, share markets, we would expect to continue to deliver longer term returns for your clients. So hopefully that helps to provide some context. The challenge, of course, is that the short term can be very confronting. Media sentiment is particularly negative at the moment. And so it's sometimes helpful to take a step back from that. Again, remember what's important to you and your clients, which is delivering longer term returns for them to help them achieve their goals. And then when you're able to maintain your focus on the bigger picture, it gives you a much more calm and orderly way to navigate pressing more near-term situations like we're experiencing at the moment. I just wanted to draw out this slide. I touched on how quickly markets fell a little bit earlier. And what you can see here is, if you're looking at on the right-hand side, the crash of 32%. So again, compared to other bull markets we've had. And so a bull market, while a bear market is simply a fall of 20% or more from peak to trough, a bull market is the reverse. So a rally of 20%. And as you can see there, this slide is capturing what happens, how long times have been good, if I can say it that way, before you experience a bear market. And the key point to draw out here is firstly, the steepness of the current fall that we've experienced, which is on the right-hand side, top right-hand corner of this slide. But secondly, an observation that it has come after a prolonged bull market. It has been an extraordinary period for investors over this time. And as I touched on at the start of the presentation, we felt that investors were becoming increasingly complacent. The risk of loss was becoming elevated simply because share markets were expensive, and it was very unrealistic assumptions were needing to be made to justify current share prices. What this chart doesn't show you is if I was to update it for the rally back out, what you would also see is, compared to these other periods in history, we've gone in very sharp, but we've come out very sharp as well. It's been a very, very quick V, if I could say it that way. Whereas the periods in the past, as you can see, generally speaking, the crash has been much more orderly down, and certainly the way out of that period of uncertainty and loss has been much more orderly on the way out. And again, perhaps that's, many of those have been driven by, more sustained or more persistent economic deterioration, if I could say it that way. Whereas for us, we've had coronavirus come along and effectively economies have had to be placed into lockdown in an effort to spread that virus. As they are, those restrictions are starting to be relaxed. Share market investors are very good at looking forward, and they're starting to take much more confidence that this was just a blip on the radar, and perhaps there's the opportunity for growth in these companies and in the economy again. I touched on interest rates a little bit earlier. It's been an extraordinary period for bond investors. And so what you can see here is that there is a very long-term trend toward lower interest rates here. That's been quite pronounced for some time. But more recently, what you can see is that bond yields are now at their lows that they've ever been. Really quite an extraordinary period. And so for those that haven't had too much to do with bonds, when a bond's yield falls, a bond's price rises, all things being equal. And so you've actually seen bond prices rally quite significantly throughout, not just this period of volatility, but certainly over previous years as the outlook for yields has fallen. Again, whether this is sustainable, hard to know. We're certainly in a low interest rate environment for what appears to be the foreseeable future. The concern, of course, is if you see any level of normalization in interest rates from here, that the risk of losing money in bonds in terms of their price, their capital price, is actually quite elevated. And the additional concern there is that those bonds that have the longest time frame to maturity are the ones that are most vulnerable to those changes in interest rates. And so it's possible you might actually see losses in bonds at some point in the future, should interest rates start to normalise from this level. And that's a concern because that's the most defensive part of your portfolio. And as I touched on, we look to that part of the portfolio to help offset share market exposure. So with the falls in the oil price, you can see on the left-hand side, so the Brent oil price is the European benchmark. And we've seen a really sharp contraction. Again, it's not the first time we've seen oil prices fall like this. We had an oil price below $30 a barrel in 2015, 2016, again, when there was some discord among the OPEC members. But it certainly, has caught the market a bit unaware the magnitude of those falls in such a short period of time. And what you can see in the purpley coloured line there is that our expected returns for those energy companies has now improved, and it's actually quite a significant opportunity for our portfolios, we think. And so what that means is that when we're looking at those companies, we're looking at the likes of BP, Shell, Total, Exxon, Chevron, very high quality businesses, multinationals. In many cases, you'd be using some of their products on a weekly basis to fuel your car and so forth. We think that they have a number of levers at their disposal that they can pull to help withstand this low oil price environment. And so that's things like cutting dividends, winding back buybacks, cutting exploration, cutting spending generally. A number of these things are starting to play out now, which is the way that we would expect them to. And more broadly, what we're looking for when we're looking for companies to navigate this environment is looking for very high quality businesses, robust cash flows. Morningstar talk a lot about moats in terms of a company. So if your company is your castle, how big is the moat around you that will help you maintain your profitability for the longer term? These are the type of businesses that we're looking for because we think that they have the ability to withstand short-term impact on their pricing and their profitability. And in fact, they may be well positioned to even pick up distressed assets from a competitor in that industry. And of course, if we can identify those high quality businesses, when you see falls of an oil price of this magnitude, that's when you get the opportunity to buy those quality cash flows at a price that's much less than what we think that they're actually worth. Much has been made of the value versus growth debate, and what the chart on this slide shows you is that growth is in green, value is in blue, and you can note the divergence over time. And what this is very characteristic of is, and again this is US data, but it's broadly consistent around the world, what this is demonstrative of is companies that are identified as growth is where people are effectively happy to pay up for growing earnings versus the value style which is much more interested in buying something at a discount to what it's actually worth. And while this is at its, it's the widest that it's been, it's certainly not our view that value is dead. We think that value will, there's certainly periods of time in history where it's been a bit out of favour, and that's the case at the moment. But what you'll find is that many of the value sectors, and I'll just jump forward onto the next slide here, they actually fall into this energy and financial space. So if you think back to my comments a little bit earlier, where it was along the lines of anything to do with economic sensitivity has been quite harshly dealt with. And so energy companies fall into that bucket, as do financials, the likes of banks. They need a healthy growing economy to give them the best chances for profitability. Those sectors have been very harshly dealt with. So, the energy sector at its lows was down around 55%, which is really quite extraordinary. And that was, key with the poor sentiment towards the oil price. And then, financials generally, because of, uncertainty around economic growth, they've also seen significant losses. But we recognise that there's high quality businesses in each of those sectors. And again, there's an opportunity for us to get them at a fraction of the price that we think they're worth. On the right-hand side, you'll see some of these more growth names. Again, if you look at the key constituents in the US market, they're very much skewed towards the top five are broadly sort of IT type names. And that's consistent with that growth focus on the right-hand side of this chart, which has been very much in favour for quite a bit of time. But again, as value investors, we believe that it's definitely prudent to have a focus on the price that you are paying always. I just wanted to share with you what some of the data we look at in terms of our expected returns. So what this chart is looking at is expected returns after inflation annualized on a 10-year view, and it's doing so in terms of global sectors. And what you can see again, the falls in some of those economically sensitive sectors like energy and financials are resulting in them standing out among our best sector opportunities globally. Again, we go much more granular than this. We can look at country and regional data, but generally speaking, they are standing out significantly compared to other sectors that we might look to invest in globally. And in the case of energy, I touched on the UK before as being cheap. Energy is also what we would consider to be cheap. And we haven't been able to say that for a while. We've felt that markets generally were quite expensive. There wasn't a lot of value or reasonable value, let alone the opportunity for us to identify assets that we think are cheap. But energy and the UK share market in particular really fall into that camp now. So that's all I wanted to formally present to. Again, just a summary of where we see our key opportunities at the moment. In share markets, we're focusing towards the UK in particular, which has really had a 1-2 in terms of Brexit and COVID-19 impacting sentiment toward that market, but also a couple of other countries there on the right-hand side that you can see, also favouring Japan and Europe more broadly at the moment, and less so toward the US. And within bonds, we think you need to be quite tailored in how you approach bond markets at the moment. There's pockets that do offer some value in terms of high yield debt and emerging market debt. But generally government bonds, particularly longer dated bonds, present the increasing risk of loss. So just in terms of takeaways, and then I might open up to some Q&A. Again, I invite you to register any questions on the Q&A tab at the bottom of your screen. What we can see is that COVID-19 has had very major implications. In many ways, a lot of the bad news has been priced into markets, but by the same token, we may have seen the lows. We simply don't know. It's probably naive to think that we're out and it's all plain sailing from here. I think the next 12 to 18 months are probably going to look pretty bumpy in terms of what corporates are reporting, what the economic data suggests. But again, we'll continue to apply our process and focus on delivering longer term returns for clients. And with that in mind, I think it's just helpful to recognise that while seeing losses are very uncomfortable, and certainly reading a lot of the news flow is equally uncomfortable, just be aware that periods of volatility and loss are normal for a client to experience on their path to achieving their goals. And as always, with that in mind, understanding where your risks are even more important before the event has taken place, not just after it. So I'm sure you would have seen many people rushing to cash after the market has already fallen. That doesn't seem to add a lot of value to me. I think if you can identify when the risk of loss is elevated, you want to take steps to do to mitigate that risk. And so Howard Marks has a saying, which I think is pretty apt. We can certainly prepare and plan for these types of events, even if we don't know what the ultimate catalyst will be and timing will be. So with that, I might hand back to Phil and take any questions you guys might have.
Thanks, Clint. That was very informative. And you mentioned the two unwords that have been used, uncertainty and unprecedented. And I do think that they've been used a lot, but I guess none of us have seen both a health crisis and a financial crisis,
of course,
before. So a lot of commentators don't know how we're going to come out of this.
Yes.
We do have a number of questions. So the first one's from Joseph. Is the market currently experiencing a dead cat bounce and is utilising cash and not leaving much dry powder, possibly a bit premature?
Great question. And the short answer is it may be. We simply don't know. Certainly investors are becoming more confident now with the improving virus infection rates that we've maybe seen the worst. But I think I made the comment at the latter end of the presentation there, that may actually prove to be premature because we simply don't. There's just too many variables here. And so we could have seen the low, we may be yet to see the low. I think from the point of view of our process, we almost don't need to know how to answer that question because we're mindful that we probably can't. And what I mean by that is that, particularly as real return investors, we'll simply size our positions in a way that is consistent with the opportunities that are in front of us. And so when we saw this period of loss in March, we were adding to our share market assets. Now, more recently, as shares have rallied out, and the bounce from the March 23 lows is pretty significant. We've actually been starting to take share market exposure back out of portfolios, and we're simply adjusting to what the opportunity set looks like, whatever that might be at a given time. And I should stress, we're definitely not all in on cash. We've gone from a point of view of holding quite a bit of cash to deploying that in opportunities that, where we can identify unloved assets that we think are high quality. We're now still holding, a reasonable amount of cash for further opportunities. And so if we do see them come along, then yes, we'll absolutely deploy into those.
Right. Thanks for that question, Joseph. One from Anonymous. What would need to happen to see a return to decent cash rates for savers? They seem to be driving towards a permanent low of late.
Yeah, I think that's a fair comment. And I would, it's hard to predict interest rates. It's hard to predict how central banks are going to behave and governments and so forth. I think they're doing their best to signal to us that we are in a low rate for the foreseeable future. If I can extend that, the massive stimulus programs that have come through, not just locally, but overseas, I think are in response to widespread concerns around deflation. So, often interest rates are going to rise in inflation, in response to inflation, but that doesn't seem to be where the key area of concern is for those government bodies at the moment. So I'd suggest that, there's the cash interest rate rises, cash rises are probably not on the table for the foreseeable future, unless, of course, you start to see funding costs and things like that that will, changes in that would change how a bank charges and lends money. That's a separate question, of course. But I think the outlook for yield assets is potentially quite challenged at the moment. Again, if I touch on bonds, which is where we would typically go for yield, I think the risk of loss in bond markets is quite significant, particularly for longer dated securities. So it just means that when you go to these particular asset classes in search of a yield or in search of diversifying exposure for your share markets, you might need to do something a bit different in our view. So that might mean you have shorter dated securities as opposed to longer dated ones, or as I touched on in the presentation, we can see some opportunity in high yield credit, investment grade credit, emerging market debt that give you a bit of a yield that you might not otherwise be able to get in some of the traditional places, but I agree it's quite a challenging outlook. I'm not expecting cash rates to soar anytime soon.
Thank you. And one from Lachlan. Do you have any comments about the potential hypergrowth of technology companies? Will it continue, or what could stop it?
That's a good question. I don't know if I have any specific comments around that. I mean, I think what's worth observing is the size of some of these companies now. So if you have a look at the top 5 companies on the S&P 500, they make up the biggest portion that they've ever made up. So that if you go back and have a look at the top 5 in history, it's now the biggest portion it's ever been. And if you have a look at those companies, the likes of Apple, Microsoft, Alphabet, Facebook, and so forth, it's all, they're the big names, aren't they? So they're very much in the news at the moment. I mean, I wonder, this has been rumoured from time to time, like government breakups of these types of dominant businesses. I don't necessarily have a view that that's going to take place, but I guess it's potentially a risk. The challenge, of course, what could stop that? I'm not really sure. I mean, we've seen things like Facebook have data breaches and so forth. But when we look at, the likes of Apple, Microsoft in particular, Alphabet as well, we think they're actually very high quality businesses. There's no question about that. They're generating phenomenal amounts of cash. They've got good, robust growth rates. The challenge for us is just the price. And there's been points in the past where we've owned both, Microsoft and Apple. Hold less of those now, of course. But, if you can get them at the right price, they're very high quality businesses. So.
Okay, thank you. Another one from Lachlan. I think the RBA has predicted roughly an 18-month return to pre-corona GDP. Would you agree with that?
Yes, I think it's a good question too, because we're not formally, trying to model it in the same way as the RBA is doing that. We're really coming at it from the point of view of valuation and if we're going to see an impairment of cash flows, how robust are the companies that we're looking to invest in to sustain that period of uncertainty and potential impairment. My personal view is that, I think that's probably a reasonable guide. Again, it is a personal view. I think you're going to see some very messy economic data, very messy corporate data. Of course, what I haven't taken into account there is, whether you do see a second surge in coronavirus infection and so forth, which could make that an invalid assumption. But from our point of view, again, we're very long-term investors. When we make an assessment on an asset class, we're doing so effectively on a 10-year view. So, more broadly, we would see short-term uncertainty, whether that's 12, 18 months, what have you, I'm not sure. But really, we want to position for those longer-term gains.
Thank you. And a question from Glenn. What do you believe will be the residential real estate market pricing impact?
Also a challenging question because we don't know what the government's response is going to be. So, conceptually we can say, okay, people are losing their jobs. There's going to have less ability to either enter the market or maintain existing mortgages. And that applies for leasing as well. So if people are buying to then lease out, the opportunity for people to rent that property is presumably going to be a bit more diminished. I mean, we don't formally model residential real estate, but we can apply some of the building blocks that we use for other asset classes in terms of supply and demand. And we know that for certain markets, and particularly in Sydney and Melbourne, there's potentially a lot of supply coming on as well in terms of units. So that may help, that may have an impact on residential pricing. But I think it's, reasonable. If we look at, if I stay with listed property for the moment, we've seen significant falls in that market. We've seen falls in many of those sort of more growth type of asset classes. So it's naive to say that you shouldn't expect some level of price fall there. Just how much of it's permanent, how much pent up demand comes back from people looking to purchase property once we start to see job creation and things like that, that remains to be seen.
Great. Now, we're just about to go 12:30 Sydney time. Clint, are you okay to start? And there's a few more questions there.
Yes.
Great,
yes.
Thank you. For those of you who do have to leave us at 12:30 on the dot, I'm sure you joined with me in thanking Clint Abraham from Morningstar, and thank you, Morningstar, for bringing Clint today. Those of you who want to stay on, please do. Clint's still answering some of your questions. So, question from Ishwar: how would you hedge this uncertainty, Clint?
Great question, because what we need to do, and so as a Morningstar, when we're investing, we're real return investors, so we're trying to effectively deliver an inflation plus objective over time, and that means that we have enormous flexibility around how we build those portfolios. And one of the things that we try and do when we're constructing our portfolios is hedge against many different things. So we don't, inflation, for instance, is very difficult to forecast, so we want to try and build things into our portfolio that can help us protect against inflation, but also help protect us against deflation. And I touched on, deflation maybe being a greater issue for central banks at the moment. So, the key here is really understanding, from our point of view, can we buy assets that are attractively priced in the first instance, and then how do we blend those together in a way that helps to deliver that diversified exposure that helps us preserve capital. And if I can take that one step further, where we would see that right at the moment is, a lot of the cyclical exposure that we can see. I talked about energy and financials. We think investors are being quite well compensated to invest in those markets at the moment. But the way that you balance that is perhaps through a higher level of cash than what you otherwise might hold. Some of those defensive sectors, healthcare and consumer staples, we don't think are going to offer as good protection as they once might have. So you're kind of ending up with a bit of a barbell type strategy. As I touched on, you might also then blend in some shorter dated bonds or some of these parts of the fixed income market in conjunction with your cash holdings to help diversify that risk. But I think that you probably what you're alluding to there is that you need to be quite nimble, and I think that's very true in this market.
I think we've got time for a couple more. One from Don. Hi, Don. US government wants to pull back 3.4 billion retirement fund out of the Chinese equity market. How's that going to affect the general market?
Right, I hadn't actually seen that news headline, but I'll have a go at maybe making an answer. The Chinese economy is enormous. As you'd be well aware, the market is less so. It's what we would classify as an emerging market. So if that potentially has some implications for the Chinese market, but I'm not sure that in itself would have broader implications for global share markets. But again, I caveat that with I haven't seen that particular news announcement, so that may have additional information there that might shape my answer.
Okay. We'll hit one more, one from Ashley. Hi, Ashley. Clint, you've highlighted the use of value in determining opportunities. Have you adjusted what value is in respect to yield for equity markets? Consumption drives the ability to deliver profit, expected growth in consumption, and therefore profit contributes to determining price. Do you see a longer period of low levels of consumer spending, high levels of savings undermining profits?
Yes. So when we're valuing our assets, we're looking for cash flows, so dividends and an element of growth, and then applying an assessment of what is the right price to pay for those cash flows. So when we're forecasting our dividends, we're doing so again on a very long-term basis. So what might we consider a reasonable dividend on a 10-year view? How might we expect growth to play out on a 10-year view? And so your question is quite right, is that right at the moment, dividends are being cut. The outlook, certainly the near-term outlook, is quite uncertain. And so the question that we must ask ourselves is, what is a temporary impairment of cash flow versus something that is structural, permanent, in which case then your longer-term numbers really don't look the same, and the appeal of the asset class might be very different. I think in terms of the assets that we're looking at, the key share markets, and I touched on energy and financials, what we can see is, yes, there might be a potential impairment to cash flows, but these are more than being compensated for in the share price reaction that we've seen in a number of these assets. And so if we believe in, the quality of these businesses going forward, then what we can see is we have a chance to temporarily get them on sale. And markets don't tend to stay cheap for too long. So we want to take that opportunity when it's there.
Take the opportunity. That's what we'd like to hear.
Yeah.
I think we'll wrap it up there. So on that note, I think there's just one last slide. Those of you who have stayed on, just a reminder that you will get an email in the next couple of days regarding your CPD, and that's for members. We've had a few requests for CPD for non-members, and we'll deal with those separately. But welcome to those of you who are not AFA members. I'm sure we could do an AFA membership package as well. Thank you for joining us today. If you haven't sat through the whole session, the video will be available on the website shortly, and there will be a quiz afterwards to get the CPD. On that note, I'd just again like to thank everyone for joining us, particularly a thank you to Clint Abraham from Morningstar. Very informative, Clint, and I know there's been a lot of requests for your slides because there's a lot of meaty stuff in there, so thank you very much. Thanks all for joining us. Thanks again, Clint.
Thanks, everyone.
Bye for now.